Everyone says the last financial crisis came out of nowhere. It didn't. Years before it hit the headlines, the warning signs were already there, in plain sight, in spreadsheets, balance sheets, and boring footnotes no one wanted to read. That's the uncomfortable truth. Financial crises are not surprises. They're ignored conclusions. And that's why this matters right now. Because today, once again, debt is high, asset prices are stretched, risk feels invisible, and confidence feels familiar. To understand why this keeps happening, forget the word crisis for a moment. That word makes it sound sudden, like a lightning strike. In reality, a crisis is a slow story with a fast ending. It always starts the same way, with something working too well. Maybe it's housing, maybe it's tech, maybe it's government bonds. Returns look steady, losses are rare. The system feels stable, so money piles in. Banks lend more because defaults are low. Investors borrow more because prices keep rising. Companies take on debt because credit is cheap. Governments expand because markets reward them for it. On paper, everything looks rational. And that's the trap, because risk doesn't disappear when things are calm. It hides. It hides in leverage, in assumptions, in the belief that tomorrow will look like yesterday. Here's the simple math most people never see. When returns flatten, the only way to keep profits growing is to add leverage. Borrow more, stretch timelines, accept slightly worse quality. Each step feels small. Each step feels justified. Each step is rewarded. No one gets paid for caution. They get paid for performance. A bank executive is judged this year. A fund manager is judged this quarter. A politician is judged by the next election. The cost of risk shows up later. The reward shows up now. So the system keeps leaning forward. And the more it leans, the more fragile it becomes. Think of it like stacking plates on a glass table. The first few are fine. The table doesn't crack. So you add more. At some point, the problem isn't the last plate. It's the weight you stopped counting. This is where predictability comes in. Highly leveraged systems don't fail slowly. They look stable until they don't. Losses spread faster than gains. Liquidity vanishes exactly when it's needed most. Assets that were supposed to move independently suddenly fall together. Not because people panic, but because they're forced to sell. A small shock hits, an interest rate moves, a borrower defaults, a bank can't refinance. On its own, it's manageable. Inside a leveraged system, it's contagious. Prices fall, margins get called, selling accelerates, confidence evaporates, and only then do we call it a crisis. By the time it's visible, it's already irreversible. Now comes the part we pretend is surprising. Afterward, we investigate, we regulate, we promise it won't happen again. And technically, we fix the last problem, but the incentives stay exactly the same. So risk doesn't disappear, it relocates, from banks to shadow lenders, from public markets to private ones, from obvious debt to hidden guarantees. Safety improves on paper, fragility grows in reality. Meanwhile, the public story stays simple. We're told the crash was caused by greed, or bad actors, or a rare shock no one could have predicted. Those explanations are comforting. They suggest the system mostly works. The truth is less reassuring. Crises aren't caused by villains. They're caused by success that lasts too long, by systems that reward leverage, by decision-makers insulated from long-term consequences, by a collective agreement to postpone pain until it becomes unavoidable. Which brings us back to today. Once again, the signals are there. High debt justified by low rates. Complex products sold as stability. Confidence built on models that assume liquidity will always exist. The details are different. The structure is not. And here's the quiet irony. Preventing financial crises would mean accepting slower growth, lower asset prices, and visible discomfort before anything breaks. That trade-off is almost never chosen. So instead, we smooth volatility, we delay consequences, we push risk forward in time until time pushes back. And that leaves one question worth sitting with. If financial crises are predictable and ignoring them is rewarded, what would actually have to change